It's a great honor to be invited to present for one of the From Local to Global workshop series organized by William Factory Small Business Incubator. I'm very happy to join a group of like-minded entrepreneurs, and I regard myself as one of you, as you will see from my background shortly. So my name is Olivia Lin Tan. I originally come from China. I came to the United States in 2000 to finish my undergraduate study, and then I got my master's degree in accounting and worked for several regional firms in the United States and served business and individual clients from a wide variety of industries, such as medical, technology, real estate, and etc. So after that, I decided to start my own entrepreneur journey. So from day one, I built my own business totally on cloud. So I can work at any part of the world as long as I have internet access. And I can serve my clients from all over the world as long as they have internet access too. So it is real example of digital business, isn't it? Disclaimer. So this presentation has been prepared for general information only and is not intended to provide and should not be relied on for tax, legal, or accounting advice. You should consult your own tax, legal, or accounting advisors based on your particular facts and circumstances before engaging in any transactions. And due to the time limitation and the complexity of international tax, in this short presentation, I will mainly cover some fundamental principles of international tax, give you a general idea of how it plays a role in your business, and the importance of working with your team of international tax professionals. So firstly, international trade and international tax. I believe everybody feels the impact of international trade in their daily life. So if you look at numbers below, in 1960, United States exported less than 26 billion and imported about 22 billion of goods and services the whole year. And if you look at April 2019, US exported less than 206 billion and imported about 257 billion of goods and services in just 1 month. So thanks to the technology improvements in communication and transportation, it made the world much smaller and contributed to the exponential growth of international trade. So why international trade? I believe it's very obvious. It helps to exchange of goods and services between two countries, promote great efficiency and keep prices down, and stimulates innovation, generate better quality products and services. So I don't think I really need to elaborate on this. As a matter of fact, I just had a new client actually came in for help with the business bookkeeping, but very interesting to know that he's in the electronic repairs and the sales business, seem to be traditional business. However, he does online marketing reaching audience all over the world. And he imports repair parts from China for a lower cost. And thanks to the modern efficient transportation and logistics, his clients can mail the electronics to him from all over the world to Washington State to have them repaired in a timely fashion. So what is the central problem of international taxation? Actually, it's the double taxation. So for a single international transaction, both countries could possibly tax on this same transaction based on their own international tax rules, such as tax residency test or income sourcing rules. So the study of international taxation really is the study of the rules that attempt to address the overlapping tax authority of sovereign countries. It's also the story of taxpayers' attempts to exploit gaps in those rules to their benefit. Now, I'd like to talk about a few fundamental principles used in international tax. So as you might know, US subjects its citizens on their worldwide income. It's not difficult to determine whether a taxpayer is or is not a US citizen for US tax purposes. When an individual is taxed on worldwide income, it often depends on the definition of its residency. For corporation, the residence test for corporation is much simpler than the test for individuals. A US corporation taxable on its worldwide income is usually a corporation created or organized in the United States. The international transactions can be grouped into two broad categories, which is outbound and inbound. The term outbound transactions refers to US residents and citizens doing business and investing abroad. The term inbound transactions refers to foreign taxpayers doing business and investing in the United States. The income sourcing rules plays a very important role on determination of whether income is taxable to certain tax jurisdiction. Different source rules apply to different type of income, such as interest income, dividend income, personal services, rental and royalty income, real property, personal property, and other gross income. The source rules apply to deductions too when you have business expenses, such as interest expense, research and experimental expenditures, and losses. Income tax treaties. The US has best network of tax treaties, which make it possible for Americans to obtain foreign tax rates and full foreign tax credit. So it helps to prevent international double taxation, reduce US tax on residents of foreign countries, and work the same way, reciprocal way to reduce taxes of US citizens or residents who received income from a treaty country. Now let's talk more about the outbound transaction. The United States taxpayers, as we mentioned earlier, are subject to immediate tax on their worldwide income, irrespective of where that income is sourced. So for individual taxpayers, if they are considered as US taxpayer, the citizens and the residents of the US living abroad, they can take advantage of the foreign tax credit or foreign income exclusion to reduce their double taxation worldwide. For domestic entities, so besides those classified as pass-through entities, such as partnership or S corporations, which the income tax attributes and the income losses flow through to be taxed at the individual level, a separately taxed entity, such as a C corporation, the residence of the entity is determined by the place where it is created or organized. So once the entity is determined to be a domestic entity, it is subject to tax on a worldwide basis. However, you could use foreign tax credits and structuring your foreign business in a certain way to reduce the double taxation, just as you could do as an individual. The inbound transactions purely refers to US activities of foreign taxpayers. So non-US taxpayers often includes non-resident alien individuals, and also non-resident corporate entities, non-resident trust, or non-resident estate. If you are considered as non-resident taxpayer under US tax law, then you are only taxable by the US on two kind of income. The first one is income sourced to the US. These are more investment income in nature. So often referred to as FDAP income. They are taxed on a gross basis at a flat rate of 30%. Or if there are treaties between the two countries, then you are possibly taxed at a lower treaty rate. Then the second kind of income is income sourced to US trade or business. So these income are taxed in the same manner as net income earned by a US resident. International tax provisions of the code provide little guidance as to what constitutes a US taxpayer. The standard for when a non-resident is considered to be engaged in a US trade or business has been developed by the courts over decades. So oftentimes the tax professionals has to look at the court cases for guidance to determine whether the non-resident is considered to be engaged in a US trade or business. So you can see that the first kind of income is taxed on a gross basis. The second kind of income is taxed on a net basis, net income basis. Comparing the foreign taxpayers and the US taxpayers, you will see that overall the foreign taxpayers are taxed on a more limited scope comparing with worldwide tax of US taxpayers. How to work with your international tax professionals? It's very important that you work with tax professionals specialized in international tax. The first, from the tax compliance perspective, there's a hefty penalty for non-compliance associated with foreign informational reporting forms. So these forms are usually filed when you file your tax return. If you look at the penalties, for example, for the F-bar form, it is 10,000 for non-willful violation. For willful violations, it is the greater of 10,000 or 50% of the account balance. For Form 8938, the penalty for non-compliance is 10,000. Form 5471, the penalty is 10,000. Form 5472, the penalty is 25,000. These are usually charged on an annual basis. So for every year you are not compliant, you have to pay that penalty. Tax planning is also very important. It should be involved from the incorporation throughout the life of the business. So you can, at the time of the incorporation, you should structure the business in a tax efficient way from a worldwide standpoint. And you should select the best place, the best state or country to incorporate your business. And always update your tax planning when there is tax law changes or when your business situation changes. Now I'm going to give a detailed example about how it's more from the outbound transaction side to explain how tax planning is important, why tax planning is important. So this is regarding structuring foreign operations. So priorly, historically, activities of foreign corporations, including foreign subsidiaries, have been exempt from US tax purpose, subject to the exceptions such as subpart F income, prefix, etc. So if you are a foreign corporation or foreign non-grantor trust, which is considered as non-US taxpayer, then income earned by this non-resident entity from foreign jurisdictions, the US tax usually can be avoided, even if all of the underlying shareholders are US taxpayers under the default US tax rules. So it creates a system incentivize income shaping efforts. So business with foreign activities, they would rather incorporate overseas in order to delay US tax imposition. Because at the individual level, the US shareholders are taxed when they receive a dividend distribution from a foreign corporation and hoping for a repatriation holiday, which allows funds to come back for a reduced tax rate. However, on the corporate level, the income usually can be deferred. And the foreign corporation is not US tax is not to be paid on their foreign income. But things changed after the Tax Cut and the Jobs Act. Now with the implementation of GILTI, which is finalized on July 20th, 2020, the ability to defer income earned by foreign corp has been reduced significantly. Also, the US corporate tax rates is reduced to 21%, a flat rate. So now, incorporating foreign activities here in the United States has become significantly more appealing, irrespective of whether foreign activities are separately incorporated in a foreign jurisdiction. So if the foreign activities are separately incorporated, the GILTI is taxed at a much lower rate for corporate shareholders. If the foreign activities are undertaken without a foreign corporation, or like foreign branch operations or operations by a foreign flow through, then the FDII benefits are available if activities are undertaken by a domestic corporation, because the 37.5% of FDII deduction results in an immediate federal tax rate of 13.125%. So in summary, priorly, it might be more beneficial if you incorporate your foreign activities overseas, conducted through a foreign corporation. Now, after the law changes, it might be beneficial to incorporate your foreign activity here in the United States, regardless of whether you incorporate your foreign activities in that foreign jurisdiction. So lastly, we're going to talk about the challenges and opportunities faced by international tax law. The US international tax laws were created in 1939, so it is really old. The reality is the US rules for sourcing and taxing effectively connected income haven't changed much to reflect the reality of doing business in the 21st century. Now, the business is more online basis. It's called a digital business. So if you look at the way people are conducting business right now, see the internet sales, remote services, SaaS, which is software as a service, PaaS, IaaS, cloud computing transactions. This way of doing business that don't exist before. So in order to catch up with the changes, how the currently business are conducted, IRS made a For example, IRS made an attempt in August 2019, the IRS issued a proposed regulations providing guidance on how to characterize cloud computing transactions. However, as of now, the proposed regulation is not finalized, and many questions left unanswered. So with the situation of lack of guidance from old international tax system, past few decades, international tax professionals, attorneys, they are what they do is they follow landmark court cases dealing with digital businesses, or writing letters to the IRS requesting tax guidance based on business specific situations. And the responses from IRS is usually called a private letter ruling. So even with the challenges and the challenges, there are still lots of strategic international tax plannings are done every year. So I would like to present a quote from international tax professionals. Says, the more informed you are about offshore tax planning, the better equipped your business will be to compete in the global economy. So lastly, we have a stronger network with international tax professionals in the US and overseas. So we could leverage our partnership to solve various complex problems with a quick turnaround time. So if your business has accounting or tax needs overseas, we're happy to refer you to our business partners overseas. So these are the two international tax accountants we work with in other countries, one in China and one in India. Oftentimes we meet and work together on projects for our international clients. Okay, so that is the presentation for today. If you have any questions or comments, my contact information is provided on the last page, last slide. Thank you again, and I wish you have a great day. Thank you. Bye.